Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today I want to talk about kind of distortions in the market, and a lot of these things are being manipulated by human beings. I don't think we've seen this type of manipulation in its entirety before. And what I'm specifically talking about is the majority of the market conditions that are being seen in today's markets are some of these things are artificially driven, and it can give false signals to people who are investors looking at some of these signals. Usually, back in the day, we would see that the housing market, aka the business cycle, was kind of driving the inputs of everything. So what would happen is people would come into home buying years. It'd be the demographic. A larger demographic came into home buying years, the credit would expand, your M2 money supply would go up based off of that credit growth, and we would see inflation from a larger demographic coming into home buying years. The interest rate would be paced by the demographic and the size of that demographic and the loans that that demographic was taking into existence. And then what we also had during that time frame is a very stable, we had stability across the supply chain. So when you had stability across the supply chain, you could use some of these inputs as leading indicators to see what was happening. So I'll give you an example. As the, we'll call it the lumber to gold ratio. If lumber was steadily being produced and gold was steadily being produced, a larger demographic coming into home buying years would increase the money supply, but at the same time, we would get these other tertiary signals in the market saying, yeah, this is definitely a legit signal. So the M2 money supply would start to creep up as loans would grow. We would see that the demand for lumber would go up because the demographic is a larger demographic. And what you would see is you would see an outperformance of lumber in relationship to gold. But that works only if you've got stable supplies, right? You'd have a stable supply of lumber, and then the demand would increase, and then the demand increase would outpace your supply of lumber. So the lumber prices would start to go up. You'd have a stable supply of gold. You'd have stable supplies of all of these different commodities. So we would use these inputs at inputs to us as an investor, giving us signals saying, look, this is where we are in the cycle. This is what it looks like. And what's getting more difficult with time is a lot of these things are broken. And what I mean by that is the supply chain of stable supply is broken. The M2 money supply being paced by the credit expansion of a new demographic coming into home buying years, which is the millennials. We do have the millennials coming into home buying years. And it is a larger demographic when looking at the demographics. It matches up very well with the baby boomers and all the other larger demographics in history. But, you know, I've got this pulled up. We'll take a quick look at it right now. That demographic isn't pacing the M2 money supply. We have an external factor that is basically in the markets, manipulating markets, that gave a bunch of money out. They increased the money supply rapidly here. This wasn't a, demographic credit-driven expansion here, which means that your interest rates could also be raised to a level that the markets cannot handle for a short period of time, which will give you false signals. It'll give you higher interest rates that the housing market may not be able to sustain because of this external M2 growth for only a period of time, though. It's not forever. It's only for a period of time. where the housing market slows down, the M2 money supply comes back to whatever growth rate that the lending supports, which the M2 money supply will go down further than what it normally would have in a free market. Then it comes back up to whatever the growth rate of the lending is in the system and the demographic can support. But that wasn't the only thing that they were manipulating. They didn't just throw a bunch of money out into the system. They also did QE, which manipulated interest rates at the same time. So not only do we have broken supply chains of a lot of these different commodities, you could consider all of them broken by shutting it down from the medical event. They threw a bunch of money into the system, which also is giving us false signals. And then they also were playing with interest rates, which are also signals to us. Now, I think them messing with this also created large opportunities for investors because there were things that happened in the markets that were larger. The distortions were larger than what they normally would have been in a free market. So the inputs and the things that we are watching, it's becoming harder and harder to discern what is real and what isn't real. And I was looking at some stuff on TradingView. That's kind of what spurred this entire thing. I'll take a look at it with everybody right now. And I do think there's opportunities out there. What I did is I took the TYX and divided it by the TNX. So basically think about this as what is the difference between the 30-year yield and the 10-year yield? And this is kind of like the last, well, hopefully they're still being traded freely and they're not doing yield curve control. But I was trying to see the spread and what that looks like. And what we're seeing with time, back in the 70s and 80s, the spreads were pretty close and they were very stable. So we had stable and close spreads all the way to about 1990. And what this is it's just the difference. It's the size of the difference between the 30-year and the 10-year. So this means that the 30-year is a lot larger than the 10-year, and then the 10-year outpaces the 30-year as this comes and declines backwards. And what I'll do is I'll add TNX, which is your 10-year. I'll put it in a new pane just to show you kind of what the yield was doing for the 10-year. So as this yield kind of flattens out, it's flattened out here. But usually the way that I see it is when this declines, the 10-year, well, either way, I'm not going to try to explain it all here. We're seeing a larger, we're seeing more volatility between the 30-year and the 10-year as time progresses. We can see it in this megaphone type pattern. And I'm just wondering what kind of, investment opportunities there are tied to TYX and TNX and the difference between those two. If you look at history, this was about 1, which means that the 30-year and the 10-year were pretty close in their yields. They would go up and down together quite tightly. And over here in 2020, in July of 2020, we had a large mismatch between the 10-year and the 30-year, which means that perhaps a paradigm shift is coming. Maybe the short end moves more drastic than the long end. But we can see that this is obviously turning up quite dramatically here and moving higher for the 10-year. So what that means is that the 10-year is outpacing the 30-year, and we're coming back more towards historical norms of 1. But when we went up in that movement, when we went up in this movement here, where we had a large, from 2018 all the way till basically 2020, that's when we had a large fall in interest rates. A large fall. We also had a fall in interest rates coming through here as well from the year 2000 all the way till 2012-ish, 2011, 2012. That was another very large move in the gold price. This gold line is the gold price. And what I'm trying to figure out, and what it seems like to me, is that when you're at a very low level here, like the 2000s, like 2018, and like we are today, is when we're at these low TYX to TNX ratio where they basically equal each other, we've seen that when these diverge, when the 30-year catches up to the 10-year, so when the 30-year outperforms the 10-year, we see a large move in gold. And one of the observations I have here is that gold is really, really cheap in relationship to, or I should say, the TYX and TNX is very low on its chart. And with this expanding movements over time, this wedge, we could see it go even higher than what we've seen in the past, which means that we could see a large investment opportunity in precious metals, specifically gold, because I've got gold up here. And I know that rare earth metals is also somewhat tied to this. I don't have it on here. But I think rare earth metals is another one that ties in with the price of the gold movement. And rare earths also have a much larger volatility, or much more volatility than gold, which means we could get larger moves against this when it all unwinds. Now, I don't know if we're necessarily done with this going down. We could still compress further, I think. And they're playing with the with the crude oil price as well, which is also playing with yields, which is playing with everything. They're doing strategic petroleum reserve releases. Those releases are playing with some of our indicators here. And I think it's probably playing with the TYX and TNX and all that other stuff. And the gold price and. But remember that this is usually a late stage performer. And what we've seen kind of historically, I think, is gold does very well in the back half of these commodity bull markets in the late stage of the business cycle. And what I'm seeing here is that we are coming to a late stage of the business cycle, and we've got TYX, TNX also aligned very well for precious metals to do well. It doesn't mean that we're at the bottom of the bottom, but it could be soon. And we could watch this as an indicator to see how this is changing in relationship to gold price. And usually what happens at the late stages of a business cycle is in the beginning, you get a lot of inflation from the loans in the system. You get a higher yields as that inflation comes into the system, puts everything into a real negative yield, bonds sell off, and interest rates go up. And towards the end, we see credit growth or credit expansion slow down. We are probably going to see that at some point. But remember, that's money that was put into the system artificially by humans. It's not being paced by the growth of the credit expansion phase. So I think we could see some pretty crazy things here where we could see new home starts slow down because of that, because of yields going to a level that are not sustained by the housing market, but were actually brought to a level by external money that was put into the system by people. It'll slow everything down, and then we'll get a speed up again at some point when interest rates go down to a level that is self-sustaining by the free market. So I think when that comes back down from the artificial money put into the system, I think we'll see an increase in gold prices. And it could happen at some point here in the near future, maybe not. We'll see. We'll have to watch it. We'll have to watch what these relationships do against each other, the 30-year and the 10-year. So that's just something I wanted to share. Hopefully you guys, have another metric that you can start viewing. And I think this is hopefully going to play out for the precious metals here at some point in the near future. I don't think it's going to be as drastic as, say, the late 2000s all the way to 2011. And I don't think that's going to be as drastic, but it could be. And with the outperformance of TYX over TNX, and as these markets start to change, we could see a vast outperformance of gold. We'll see. We'll monitor it. And if you guys want to monitor it with me, definitely subscribe to the channel. If you guys want to get more in depth of how to play all this, become a platinum member in the description link below. That's my website. Platinum member will get you information of how I'm playing all this and the companies that I'm playing. All right, guys, that's what I've got for today. We'll catch you next time. This is Finding Value.